Okay, so this is my own little walkthrough video so I can memorize the steps, and if it helps anyone, then better. So the following materials standards have been established for a particular product: standard quantity, standard price. The following data pertain to operations concerning the product of the last month. We have actual materials purchased, actual cost of the materials, actual materials used in production, and the actual output. They're asking what is the material quantity variance for the month. So I would do, it's the 3 A's first. So actual quantity, actual price, and then we have actual quantity again. Now the 3 S's: standard price, and then standard quantity allowed for that amount, and the standard price again. So let's get these numbers first. The standard price is right here, right? So right there, we have standard price, and we can just type that in. 1980, 1980. Standard quantity. Here we have to pay attention, because if you're talking for the month, it's not the amount of units that were purchased. That's not it. We're going to use the amount of units that was actually used. So that would be this one right here. That's what we need for actual quantity. So our actual quantity is 5,100. And what's the actual price I paid? Okay, so the price that I paid is this price for all of those. So I just have to calculate 113,680 divided by the amount of units I bought. And here I have my actual price that I paid. What about this one? This is a standard quantity, which is 1.7, but we're not going to put 1.7 here. Look, we have to compare to this one. So it means, what's the standard quantity of product that we would use to produce this amount of hours? Oops, right there. So we have to multiply the actual output by the standard quantity to get a standard quantity allowed. This is 1.7 times this. Okay, now we can just do this so it's more organized, and multiply one per other. So this times this, and just carry this. We can. So here we have one of the pieces of information. Oops. One of the pieces of information that we need. Here we have the other and the other. Now we're going to compare, right? That is part of the above. So the difference of the actual quantity and actual price, and the actual quantity and standard price, this is what I actually paid, and this is what I should have paid with my standard and planned price. So what's the difference? So just looking here, I know that this number is higher, so the standard price would be higher. So in other words, I spent less. And if I spent less, and you can just see that the actual price was less than the standard price, it means that I saved money, so I know it's favorable. And it doesn't matter if I do this one minus this one, like minus 1,020, or if I do this one minus this one, it's irrelevant. You don't have to pay attention on the positive or negative symbol. You just have to know if you saved or not. And here I know I saved. So in this case, that's not the answer yet. This is the price variance. And now this would be the quantity variance, right? Why am I doing everything? Because I think they can just give us the same numbers and change the question. So this is the quantity variance. So again, it doesn't matter which one minus this or this minus this. I just have to see what number is the smallest. Okay, this is the smallest. It means that we used less quantity. If you actually see, we have the standard price here and the standard price here. So to produce these amount of units, this output, I planned to use this amount of product, but I ended up using less. So it's favorable. So the answer for this question is 6,732, and it's favorable. And there we go. That's the answer for this one. Oh, I cannot stop recording. Okay, so this is the second question that I have, and it says, Cash Incorporation makes and sells a product called mini warp. One mini warp requires 1.5 kilograms, so that's an information I'm gonna need later. They require 1.5 kilogram of the raw material, blah, blah, blah. Budgeted production of mini warps for the next 5 months is as follows. They're asking for, and I try to read what they are asking first before I keep going. They're asking for desired ending inventory of raw materials, right? The raw material for September, desired ending. Okay. The company wants to maintain monthly ending inventories of Jerusalem, whatever the raw material name is, equal to 30% of the following month's production needs. So here we already have kind of what we need to answer the question. On July 31st, this requirement was not met since only 10,400 kilograms of Jerusalem were on hand. The cost is 4 per kilogram. This is important because if you see here, they're asking us in dollars. So how can we solve this? Well, the easy way I would say is, so the desired ending for September is 30% of the following month's production needs. So for October, I want to produce 24,600 units. And I know that each unit requires 1.5 kilograms. So 1.5, and then I know the production needs for October are 36,900. And I want to have, in the end of September, 30% of it. So 30. Okay, but this is in pounds, and they're giving me answers in dollars. So I multiply this times $4, which is the cost per kilogram, and that's how we get this one. Now, the first time I did it, I didn't do it this way. I went into the whole budgeting schedule for the whole month with the other information that was given, and I got the information, I got the same answer, but if you look at this way, it's much faster, right? Okay, so the third one, this corporation makes a product with the following standard cost. We have standard quantity of hours, the standard price, the standard cost per unit. The company reported the following results concerning this product in December, blah, blah, blah. The company applies overhead on the basis of direct labor hour. The direct materials purchases variance is computed when the materials are purchased. And they're asking for labor efficiency variance for December. So same thing as with three A's and 3 S's, but this is for labor. So instead of price, we're going to call rate. Instead of quantity, we're going to say it's efficiency, right? So it's actual hours, the actual rate. And then we have actual hours again, now the 3 S's. Standard hour, standard rate here. And then here we have standard hours, but this one is the allowed one. And then we have standard rate. And then we just get the information that we have here first to get this. So for materials, it's quantity, price, and here it's hours and rate. Okay, so there we go. And this, let's just merge so it's better. So here we go. We have standard quantity of direct labor hours. We have it right there, right? We know that the standard quantity of the direct labor hours is 0.7. And the actual output was this. So I know that my standard hours allowed is how much I plan to spend in each product times my output. So this is 0.7 times 4,200. Okay, the standard rate, how much I usually pay for my direct labor hours is right here. Oh, no, sorry. It's right there, $20 per hour. So my standard rate is 20 and the standard rate is 20. Now, how many hours did I actually use? Oh, actually, we found another information here first. We have the actual direct labor rate. How much did I actually pay my employees? Only $18.30. That's an information in a piece of information that I need. In hours, let's see. Actual direct labor hours. There we go. Here we have that information. 31.60. This is 31.60, and this is a safe piece of information, 31.60. So just multiply this by this. You can carry that over. And then they're asking for, if they were asking for the rate variance, that would be this minus this. And it doesn't matter if I do this minus this or this minus this, because I just have to check. Okay, look, the hours are the same. So this is the actual rate, the standard rate. I actually spent less than I would have, so it's favorable. And this is what they call the labor rate variance, which is not what they're asking here. And here we do this minus this or whatever other way around, it doesn't matter. And this is the labor efficiency variance. Now, was this favorable or unfavorable? If we analyze it here, we have the hours are the same. Actually, sorry, the standard rate is the same. So what they are analyzing is how many hours did we actually use to produce this product. So we used more hours. If you compare this with this, or just the number, the ending result, this one is higher, so it's unfavorable. I spent more hours. The efficiency was not as good as it could have been. So the answer is 4,400, and it's unfavorable. So this one got me a little confused because they are mixing two kinds of budgets on the same questions. So they say, has the budgeted sales for the year as follows. The ending inventory of finished goods for each, just before we continue, what they're asking here is scheduled production for the third quarter. So we are talking about the production schedule, right? Okay, let's call the production schedule the yellow one. The ending inventory of finished goods for each quarter should be 25% of the next quarter's budgeted sales in units. Okay, this is for the production schedule. The finished goods inventory at the start of the year, okay, this is my beginning inventory. The start of the year was this amount. And then they start talking about raw materials. 4 pounds of raw materials are required for each unit produced. Raw materials on hand at the start of the year totaled 4,200. The raw materials inventory at the end of the year, at the end of each quarter, should equal 10% of the next quarter's production needs in material. So we have two different budgets here. And when I did it the first time, I did the whole raw material and then the production budget, but we don't have to. It's much easier if we just have those two pieces of information. They're asking for the third quarter, right? So we have to just do the production budget, which is, we have first the budget, budgeted. Uh-oh, okay, let's just do this. Units, and I have here quarters 1, 2, 3, and 4, and it's 10,000, 12,000, 14, and 16. That's it. So I have to add desired ending, and then it will have total needs for production, and I subtract my beginning inventory. So if I do this, I'm gonna have the scheduled production, how much I have to produce, how much I have to make in my company to meet my goals. So the desired ending, we know it should be 25% of the next quarter budgeted sales in units. So it's that times 0.25. And we are answering for the third quarter. That's what we want to look for information on, right? Okay, so this plus this, those are my needs, but I already had on hand my beginning inventory, so I don't need to produce whatever I already had on beginning. And it tells me that the finished goods inventory, the start of the year, was 2,500. What about on month 2? Well, it's my desired ending. So here, desired ending. I might hear my cat is not happy. How many units do I actually have to make? What I have to make to complete my sales of the month plus my desired ending minus what I already had on hand. So this is it. So scheduled production for the third quarter should be 14,500 units, and that's the answer right there. Okay, so question 5 is the same as question 1, exactly the same, so we don't have to do it. Question 6. They're asking for, based on this data, the balance in accounts receivable on January 31 will be. Okay, so we know what we are looking for. So Home Corporation will open a new store on January 1st. Based on experience from its other retail outlets, Home Corporation is making the following sales projections, blah, blah, blah. Home Corporation estimates that 70% of the credit sales will be collected in the month following the month of sale. Oh, because they have two kinds of sales. They sell on cash and then they sell on credit, right? So 70% will be collected in the month following the sale, with the balance collected in the second month following the month of sale. That one I thought was the easiest one, in my opinion, because credit sale, how much will I have in accounts receivable in January? And that's the answer, 40,000, because I'm going to collect 70% of it in February, and the balance I'm going to collect in March. So at the end of January, my account receivable account will have $40,000 on it, and that is the right answer. We go to the next one. Let's delete whatever was here before, so I have to do the walkthrough again. So this is a small one too. Lawrence Tailings, let me make it bigger. Cost formula for its materials and supplies is $22.30 per month plus 1 per vehicle. For the month of November, the company planned for activity of 75 vehicles, but the actual level of activity was 25. The actual materials and supplies for the month was 2,160. The spending variance for materials and supplies in November would be closest to, so spending variance. The way that I did it is, how much did they actually spend? So actual amount, actual price, the actual material and supplies for the month were actual 2,160. How much was planned? So standard cost allowed by this amount, right? The actual amount was 25. So we have here the fixed portion standard. The standard would be 22. 30 plus $1 per vehicle, we have 25. And then this plus this. This is the two sides of the equation, right? If you think about it that way. So what's the difference? This minus this. So before we keep going, is it favorable or unfavorable? We can enter it here. So I actually spent less than what I planned for. So it's definitely favorable because I saved money, and that is the answer. Another way of thinking about it is just like dividing it a little bit further and doing the actual quantity and then the actual price. Oops. Actual price, actual quantity, standard price, and standard quantity allowed, and the standard price. And we would have, if we do, just remember that they're asking for the spending variance. So if we, the difference between this and this is the price or rate variance between those two. Let me put it in other ways. So this difference right here between those two, that is the price variance or the rate variance, the same. The difference between those two right here, that is the quantity variance or the efficiency variance, is the same, but the difference between these and these is a spending variance, and that's what they are asking for. Okay, 3 more to go. So in this one, they're asking for, and I already can keep an eye on that, January cash disbursement for manufacturing overhead on the manufacturing overhead budget. Okay, so the cash disbursement for January. Let's see what information we have right there. So Moorish Inc. bases its manufacturing overhead budget on budgeted direct labor hours. The direct labor budget indicates, let's say, hours. We have 8,400 direct labor hours will be required in January. This is January. And we know the manufacturing overhead rate is based on this, right? The variable overhead rate is 1.50 per direct labor hour. So we know that the variable manufacturing overhead rate is 1.50. So the variable portion of my manufacturing overhead is the amount of hours that I have times my rate. And this we could say is a total variable manufacturing overhead. It's my total variable. That's not the question yet. Now we have to see my the fixed part of it, right? So the company's budgeted fixed manufacturing overhead is 100,310 per month, which includes 9,040 of depreciation. And that's the tricky part right here, because when we calculate manufacturing overhead, depreciation is a non-cash expense. And because it's a non-cash expense, we do not calculate it in cash disbursement. Like money doesn't leave the company every month to pay a bill for depreciation, right? So we would do total variable manufacturing overhead plus my fixed manufacturing overhead, and then I'm going to subtract 9. So from my total, this is my total manufacturing overhead cost, right? Which includes the variable portion, and the fixed portion. But then I have to do less depreciation because that's a non-cash expense, because I'm calculating for cash disbursement, how much money it's actually leaving the company. So it's my total manufacturing overhead less depreciation, and that's the answer. Let's see. Okay, one more. This one, when we were doing the study group yesterday, was like super not complicated, but we did lots of calculations, and there is a way to do it that way, but there is another way that is a little faster. So what's the spending variance for laundry costs in the performance report for the month? So laundry, that got me confused a little bit, but look at the information that we have. We know that, oops, is there anything here on top? Just information about the hospital. So we are solving for laundry. This is the static planning budget, and this is here we have the actual results. So how much did I actually spend on laundry? This is my actual spending. In other words, that is the same as my actual quantity times my actual price, right? If you think about the equation, we have that, which is that number right here. We don't have the amount of quantity, but that's okay because we already have the result, right? 17,650. And then we have later actual quantity at standard price. And then we have standard quantity allowed times standard price. The difference between those is the price or rate variance, That's not what they're asking for. The difference between those two is what we call the quantity variance or the efficiency variance, but they're asking for the difference between those two ends of the equation, and that's what we call the spending variance, and that's what we need. So we have that information. We have this one. Hey, we do. Where? Right here. So we know that what I planned for was, they give us this number, but this is what we have to pay attention to. We planned to spend $490 per patient visit. And we do have the amount here. I said we didn't have the actual quantity and actual price, but we do. Look right here, the actual number of patient visits. So what I have to do is, I do 4.9 times 3700. That's gonna get me this number right here, 18,130. And that's the quantity allowed by the actual price. I understand that this is my standard quantity allowed in this question. So the difference between this and what I actually spend. So look, this is my blend, right? Standard, how much I would have spent for 3,700 visits and what I actually spent for 3,700 visits. And the difference, this minus this, 480. Is it favorable or unfavorable? But look at here, I spent less than we planned for, so it's definitely favorable, and that's the answer. And the last one, we had one of those in so the other file that has 5 questions has one of like these as well. So here we have information for 2 different budgets. It says, Carter Lumber sells lumber and general building supplies for building contractors in a medium-sized town in Montana. Data regarding the store's operations follows. We have sales, we have to find for retained earnings at the end of December. What we have here is we have information of our retained earnings at the end of October. So we have to carry it over to December. But what affects retained earnings? So if you remember, for retained earnings, we do beginning retained earnings, and then we add net operating income or net income, and we do less dividends, and we are going to have our ending retained earnings, right? So if we have our beginning retained earnings for, and this is for October, I mean, we have the ending retained earnings of October is the beginning retained earnings for November. So just need to work with 2 months and December. So my beginning return earning is that yellow figure right there, 259,600. Oh, add net operating income. So I don't have that number. So I have to go and figure it out. How do I do that? What is net operating income? We have to do sales, right? And then cost of goods sold to figure out gross margin. And then we have to do expenses, and that's how you're going to get net operating income. Let me make it a little bit bigger. Okay, this is November and this is December. So do we have sales information for November and December? We do. Sales are budgeted for 380,000 for November and 390 for December. So December, I can put that information here. 380 and 390. My cost of goods sold. Well, let's read that information now, right? So sales are budgeted. We just used it. That was useful for us. Collections are expected to be 70% in the month of sale and 27% in the month following the sale and 3% uncollectible. So how much of this is relevant? The first time I did this exercise, I was like, oh, I have to put everything in, but no, we don't. Why? Because net operating income tells us how much revenue we generated. It doesn't tell us how much we collected here or later, accounts receivable, if I accepted to be paid 2 months later or not. We're just analyzing how much revenue my company generated on that month. So this information right here, collections are expected to be 70%. That's irrelevant for us because it does not affect net operating income. 27% in the following month, that's irrelevant for us. But this piece of information right there, this 3% that is uncollectible, this is relevant because that's a loss that affects our net operating income. I mean, I'm never going to collect that. Those are people who didn't pay me. Cost of goods sold, we just found it, is 75% of sales. No, 75, sorry, 65. That's my problem with numbers. So 65% of sales. So cost of goods sold equals my sales times 0.65. We can just, and gross margin is sales minus cost of goods sold. That's the same, so just carry it over. So now I have to do less expenses. What expense do I have? Oh, we just have read about one, the 3% uncollectible. So 3% of sales are uncollectible. I sell 100, I'm only going to be paid 97. So that's called bad debt. So it's that times 0.03. Do we have any other expenses? Let's see. The company desires to have an ending merchandise inventory, blah, blah, blah. Irrelevant for me right now. That has to do with the production schedule. So that is irrelevant as well, right? It does not affect net operating income. Other monthly expenses to be paid in cash. Oh, that's relevant. We have other monthly expenses of 22,000 and monthly depreciation of 20,000. And that does affect here. So expenses and depreciation. That was 22,000 and this was 20,000. I just carry it over. These is fixed, so that's why they are the same, and this one is 3% of my sales. So my net operating income equals my gross margin, less my loss, my expenses, and my depreciation. Depreciation is a non-cash expense, but it does count for net operating income. So add, so I had here my beginning return earnings, right, that I got from this part of the information right there. So I have to add my net operating income. We don't have dividends, I just put it here because what if we get it in a question, right? But then the answer for ending return earnings in November is the beginning plus my net operating income minus dividend if I had it. That's it. What about December? So if I ended with this, that's the beginning for December. So I add net operating income of December that we already have. We don't have dividends. This plus this minus dividends. That's the answer. So my ending return earnings for December is 422,000, and that's it.